The penalty itself of the income tax, which has created disruptions, considering that we had the paper on penalties. For this penalty, we had two stalwarts from profession. The chairman, Mr. K.P. Kumar, who has been in the practice of advocate since 1966, and he has been designated as a senior advocate in 2003. He is with the firm King and Partridge, which has been 155 years old. He had been on the board of various corporates and was a chairman of Kaur Vaishya Bank for the period 2010-2015. Paper writer CA Chetan Karia, who doesn't believe in giving his own introduction, is a chartered accountant. Besides being practicing as a chartered accountant, he has also been a trained mediator from the Bombay High Court and practicing in the field of direct taxes and mediation of the commercial disputes. With this, few words are present before you today's chairman and speaker. Welcome you to it. Welcome them with a loud applause. May I request Ashok Sharma to present a memento to the chairman, Shri K.P. Kumar. May I request Chetan Vajani to present a memento to CA Chetan Karia. With this, I hand over the proceedings for the session to Chairman Shri K.P. Kumar.
President and Chairman of the Chamber of Tax Consultants, Mr. Chetan Karia, the paper writer. Am I audible or Mr. Savla and Mr. Hemant? I was very impressed with the manner in which the group discussions went on in the forum. And you have chosen a current topic for serious deliberations. See, one of the problems which we are facing in our country is, by the time the law settles down, it undergoes a change. This is what has been happening in all spheres of taxation. Less in other areas, but in tax very often. The sales tax, which came into being in 1938, went on for about 70 years, and then they replaced it with VAT. And we started settling down with VAT. Now GST is coming. By the time GST comes in, we would have to forget what the VAT law was. Same thing with the income tax and excise, customs also. As Nani Palgiwala put it, the government and both the houses of parliament as well as the state legislatures ensure that the practitioners, lawyers and chartered accountants are assured of livelihood for all time to come, as amendments will be coming regularly. So the need for consultation will be increasing all the time. I am not going to take much time now because Mr. Karia is going to present the paper. I am only going to introduce the topic. 270A has been introduced into the statute with effect from 1st April 2017. which means by the assessment year 2017-18, whatever be the penal provisions on concealment or suppression of inaccurate particulars will be dealt with by 270A. Broadly speaking, 270A is slightly wider than in scope than 271(1)(c). The broad difference is basically in 271(1)(c) there was a requirement to establish some amount of guilt or default on the part of the SSE. But under 270A, when it comes to underreporting, the statute presumes the states on which the penalty is to be imposed. Although misreporting is a species of the genus underreporting, because underreporting in consequence of misreporting will carry a higher rate of penalty of 200% of the tax. It may be necessary for the officer who is completing the assessment or the commissioner who is passing the appellate order to bring about some amount of guilt on the part of the SSE or deliberateness in either concealing or furnishing inaccurate particulars of income. These are the two broad areas of difference. Otherwise, the procedure is broadly the same. The memorandum explaining the bill does not really say what was the objective with which this was brought in, although it says to rationalize and bring about objectivity, certainty and clarity. I am not too sure the provisions are that clear for one to understand, because there are too many grey areas and the board has not come out with any guidelines or circulars or parameters as to how the provisions are to be interpreted. And there are some areas of doubt as to whether 270AA will turn out to be illusory, because there are no guidelines in what cases the officer is justified in accepting or granting immunity. These are all some of the areas which are to be deliberated. And on top of it, there are so many posters which Mr. Karia had given, which were deliberated by the group discussion. Very interesting discussion. So with these few words, I request Mr. Karia to present the paper, and thereafter we can deliberate. Thank you.
Before Chetan Bhai starts his presentation, may I request Shailesh to make some announcements? After? Okay, Chetan Bhai.
Chairman, Mr. Kumar, Paras, Himanshu, and all my dear friends, and actually I will not say friends, quite a few are my nephews and nieces now, because their fathers are my friends. The topic that is there before me, penalty and prosecution paradigm shift. Obviously it is in context of removal of section 271(1)(c) from AY 271(1)(c) and introduction of 270A. In the current scenario that we are living in this country, I would like to put a disclaimer. Normally I would never do this as a technical discussion. Tax evasion has to be punished, undisputed. Nobody, or whatever further I will be discussing from here onwards, there is no attempt to say that tax evasion should be controlled. But having said tax evasion has to be punished, the question arises, who is tax evasion? And that is where the lines get blurred. That is where the whole dispute starts. So when we are discussing this, section 278, frankly telling you, it's so new, we all aware, but so new in the sense there are so many errors there that I felt like yesterday when I was landing, that yes, in Bangalore, where they write softwares and programs, they use the terminology of debugging the program. That is, before they deliver the software or the program to the client for implementation, they have their own team to debug, to see what are the problems that will arise and whether it will be able to handle those problems. Frankly, this discussion is more of that effort to debug the existing provisions. Really, does it achieve what it is trying to achieve, or is it going to create a wider gap, a wider loophole for real evaders to escape? This is where, really the debugging exercise, and really I would like to focus on that. Yes, the mindset behind introduction of this provision very clearly is the department, the legislature through the department likes to believe that every addition that is made in assessment proceedings should be subjected to penalty. This is bottom line of the provisions that they are introduction. The mindset behind it, whether they will be able to achieve it, whether it will happen is secondary, but the first thing, the mindset which is there, and that is where I have a problem, frankly. Can't hear me? No, somebody raised their hand, sorry, okay. The mindset that every evasion, every addition has to be penalized. Is it clear now? That is where there is some problem. If one thinks of that if I am going to say that every taxpayer in this country is a tax evader, what situation that will arise is that the real tax evader is smart enough, he has already evaded tax, he will also evade penalty. The problem will arise for the honest. The problem will arise for the person who doesn't have the wherewithal to really do a evasion, and it is those people, I am sure, yes, they are going to be caught. It is the people who have not made any error with a guilty mind, with a knowing thing that, okay, this is what I want to achieve, this is where I want to pay the less taxes. These are the people who are surely going to be caught by it. But the intention that who are the evaders, because the basic thing is, one can look at psychology. If you treat everybody as a thief, if you treat every person in a group of person as a thief, you are going to end up with a situation where that the real thief will be the first person who will escape. This is a common thing, that the moment you say everybody is a thief here, you are going to have a problem in finding out who is the real thief, because then you really don't know, you are treating everybody as a thief. Now, with this background, let us try to understand 270A, 271(1)(c). Because of shortness of time, and I could see in groups, we have already discussed 271(1)(c), you already discussed basic provisions of 270A. And therefore, let us understand a few basic things that will arise. Looking at the way the section is structured, 270A, the first and foremost, the first poser, why did I put it? The reason being, yes, somewhere the wordings are very harsh of section 270A, and the person may find that he is getting hit by it. Question is that, is it only what is provided in section 270A? The basic structure of 270A starts with 271(1)(c) says, if there is a concealment or furnishing of inaccurate particulars, you are liable to penalty. And deeming provision is that if this has happened, it will be deemed you have concealed. The current set of provisions are going the reverse. Instead of saying that in this circumstance you are evaded, they are saying that every case there is a difference between the assessed income and the return. The provisions will come to whether there is a difference between 143(1) and 143(3) income, you have underreported your income. And then there is an exception in subsection 6, 3 or 4 subsections are provided. What if a particular SSE finds that it doesn't fall within those exceptions they are provided, because they are wide but they are restricted itself? I would say section 139 would still come in whenever there is an issue where a person may not specifically come under section 140. A penalty is basically for doing or not doing something which is codified or not codified. I'll give a simple example what I mean by codified, not codified. There need not be a law to say that you can't thief. There are certain basic parameters of social behavior. One need not provide that you will not do this, and there can be a penalty for doing it. But when I'm dealing with Income Tax Act, it cannot just say that you have done this and therefore I am going to levy penalty for this. There has to be first a duty on you. What is the duty on me? Is there in the note, section 139 says you have to provide the return. But what does the verification say? This is the core, the return that I file. Read the verification. The verification says, to the best of my knowledge and belief, this is the first and foremost, I will say, safety that is available. Even if an SSE doesn't get the benefit of subsection 6, the SSE has to report his income, though the word is not there, reporting at requirement starts with section 139. To the best of my knowledge and belief, the information given in the return and schedules thereto is correct and complete. Amount of total income and other particulars shown therein are truly stated and are in accordance with provisions of IT Act in respect of income chargeable to tax for the relevant previous year. That is what the SSE is asked to do, is to give a computation of his income in accordance with the Act to the best of his knowledge and belief. To the best of his knowledge and belief. So as long as nothing else works for an SSE, there is a show cause notice. One can always go back, I would say, to section 139. The reply to show cause can say that, sir, what I have done in the return is to the best of my knowledge and belief of what are the provisions of the Income Tax Act. So still there are debatable issues, there are two views possible, all those arguments available, because what I am required to do, why am I being penalized? Because my return is not in accordance with the law. What the return requires me to do? To say to the best of my knowledge and belief that the income is in accordance with the provisions of Income Tax Act. So I would say all the decisions that were there in 271(1)(c), I am purely dealing with cases who are not concealed cases, really concealed cases. These are cases where there are difference between your returned income and assessed income. Section 139 itself would help an SSE to say, and I would suggest that yes, a reply to show cause notice, if you don't fall in subsection 6, should say that, sir, my liability was only to do this, this is what I have done, and there cannot be a penalty for doing something which is not prescribed. I have been told to do this is what I have filed, this was the view prevalent at that time, and I have adopted that view and computed my income accordingly. I would say this is the basic core available to us even before we go to section 270A. So what was enshrined in section 270(1)(c) was coming out of section 139. So even if they change 270(1)(c), merely changing 270A, in my view, is not going to take them that far. Now coming to the new set of provisions, along with 270A, they have brought in simultaneously an amendment in section 143(1) to say that there will be adjustments on 4 accounts. Adjustment on account of disallowance of loss if earlier return was belated, disallowance of exemptions and deductions if return is belated. These are, I would say, to that extent not controversial. But the two controversial amendments in 143(1) has a direct impact on penalty. One, disallowance of expenditure indicated in audit report but not considered. Now what does indicated in audit report mean? My own audit report, my auditor puts a comment that 40A3, the SSE does not maintain evidences to prove whether the expenses are by account paid check or not. Does it indicate that all my expenses are to be disallowed under 40A3? It says disallowance of expenditure indicated in the audit report. The audit report is indicating that I don't have evidences to show that I have made payment, I have complied with 40A3 by making payment by check. Is it sufficient? It's very wide. 2. Addition on the basis of 26As, Form 16A or 16. That is, if there is an income in 26As but not shown in my return, they can add it. Both these additions are going to take place in my own case. I am not going very far. And let me assure you, my whole receipts are getting accounted. These two adjustments are going to come in my return in the next year itself. Something or other would be indicated in the audit report. I would have my own view about it. I would say, sorry, I am not disallowing that. And second, my clients follow mercantile, I am following cash system. So these two variations are invariably going to come. This is what they have said, 143(1). They have made it mandatory now that 143(1) will be passed irrespective of 143(2) notice being issued. And they have said, as law then provided in 16, that a 143(1) intimation will be given even before, just before assessment order is passed under 143(3). In 17, they have tried to amend. There is a proposal in the finance bill to amend, but according to me, it doesn't change the situation. What they are providing now is, irrespective of any circumstance, there is always be a 143(1), and this becomes important for the purpose of penalty. And this is where a major first loophole comes in. They have provided now that 270A is on account of underreporting. First, the larger set. If we go back to mathematics, there is a set and there is a set within the set. So misreporting is a set within the set of underreporting. Let us look at the larger set of underreporting. They are saying the difference between 143(1) and 143(3) will be the underreported income. So far so good, so that is what their intention, every addition there should be penalty. They have said every case there will be 143(1). A day before, subject to your 139(5), you utilize the time of 139(5) and file a revised return, he will be bound to make a 143(1) again. When you provide for strict rules, so that you are saying that every case comes in penalty, they have come up with a situation, 143(1) and 143(3) will be compared to find out what is the amount of concealment. I am using the old word, what is the amount of underreporting. Now 143(1) is mandatory. So if you file a 139(5) return, if it is within the time available to you and offer all over that is detected, he will not be able to levy penalty, though under the old law, the penalty was in the context of the first return. Under the new law, if a 139(5) return filed within time, then the penalty will be in the context of the second return and not the first return. This is the first major bug, I would say, is there in these provisions, because they wanted to be sure of what they are providing. So they have provided a rule that 143(1) will be made irrespective. B, the difference between 143(1) and 143(3) is underreported income. You file a 139(5), if it is valid, he is bound. Even if he doesn't do it, 143(1) provides that if no intimation is issued, then the acknowledgement is the intimation issued under 143(1). So the mere filing of 139(5) within the valid time will wipe out all your crimes. A smart tax evader, if he has come to know and he has time available for 139(5), he has to just file a 139(5) return. He might have committed a murder, dear sir, you will not be able to penalize him. Because your underreporting starts from 143(1) to 143(3). There is nothing in between. So the first major bug, and I would say major because it is going to help only the evaders. They are knowing what is going to happen, they are going to use this. Whether they can correct this, very doubtful, because they have gone rule-based. The moment they will go back to the return, again there will be problems in understanding it. So the way they have structured it, a major bug is coming up upfront first spot, that in the computation of underreporting income, they are excluding revised returns incomes. Whereas the law is well settled that merely because you have filed a revised return doesn't mean that you are not liable to penalty in context of the first return. Yes, 139(5) valid return has to be there, but yes, this is the first thing that has arisen. The first bug that I could notice that yes, this is where there will be a problem. The second issue, this is where we were discussing with the chairman also, and ultimately both of us concluded that the department or the government one should say the view, take the view, heads I win, tails you lose. Whether penalty will be levied simultaneously, some groups came up with a suggestion that probably even after 5 years, yes, possibility. The way the section is drafted, 270A, an assessing officer can levy the penalty simultaneously with the assessment order also. The provisions are so structured, rather I will go to the extent to say that it is possible for him that this is how a circular has, this is one of the rarest of the things, nearly 8 months, we don't have a circular how this law is going to be implemented. Till date what we have is memorandum and it is repeated in the subsequent 2 circulars. The AO may, during the course of any proceeding under this Act, direct that any person who has underreported his income shall be liable to pay a penalty in addition to tax assigned. There is nothing that stops the AO from levying the penalty subject to other conditions of 274. So what they are trying to probably say is that we are going to levy penalties simultaneous with the assessment. But can I challenge it if it is not levied? No. They are still stayed by section 275. Even if they don't levy it simultaneously with the assessment proceedings, they will still levy it later on. It is only that in the course of some proceeding he has to pass an order. Suppose he misses out, this question came up in some group discussion, yes, I would say the way it is worded, it is possible that he misses out issuing show cause notice during assessment. During some other proceeding, say TDS violation or something, it comes to his notice that is underreported, he can still issue a show cause notice. There is nothing that bars them. I am not saying they will do this, but at present the way law is, it seems that it is all the 3 years possibility that the assessment proceeding itself will have a penalty order, and this was In fact, if you recollect, when Kelkar committee was sitting on this, a very strong proposal was there that they wanted assessment and penalty to be simultaneous. I have a feeling this is what they want to do, that assessment and penalty would be simultaneous, but the way it is at present, yes, it is also possible that the penalty may be levied at a later date. So this is the second proposal. I am missing out a few ones where there is no discussion, no need for me to give a separate opinion. The main one, and that is subsection 6. Subsection 6 provides something similar to explanation 1. It says the underreported income for the purpose of this section shall not include the following. There are 5 circumstances there. A is somewhat similar to explanation 1. I'll simultaneously look at section 7 and 8, subsection 7 and 8. 7 says penalty referred to in 1 shall be 50% of tax tax on underreported income. 8 says notwithstanding anything contained in 6 or 7 where underreported income is in consequence of misreporting thereof by any person, the penalty referred to in subsection 1 shall be equal to 200%. So A, they are providing the larger set underreported income, and they are saying these are the cases where it shall not be treated as underreported income, 5 circumstances. Then 6 provides the penalty on underreported. 7 provides penalty on underreported. 8 says notwithstanding 6 and 7. And then only says that underreported it is 200. So this notwithstanding, does it take care of subsection 6 fully? In my view, after starting with notwithstanding 6 and 7, they have only provided larger penalty, not said anything else. In my view, even for misreporting, you have a chance to say 6 will apply to me. That is, I can give even in a misreporting circumstance that I am getting out of ABCD. Now, what are the consequences of this? Very simple. I am toying. I am not suggesting for anybody to follow this. Look at clause C of subsection 6. The amount of underreported income determined on the basis of an estimate, if the assessee has on his own estimated a lower amount of addition or disallowance, has included in the computation of income and disclose all facts. Suppose an assessee were to file a return, pick up his P&L account and balance sheet. Every item of receipt he will say estimated receipt increasing by 1 rupee of his book of account. Every item of receipt. Every item of expense he says 1 rupee on estimated disallowed. He picks up his balance sheet, says every item on liability side is an unaccounted receipt, 1 rupee estimated. Every item of my asset, there is 1 rupee additional unaccounted investment. All this he does, he files in the return. If for a misreporting circumstance, he's got subsection 6, this probably 100 rupee insurance will ensure that he'll never be liable to penalty. An evader, a person who knows that every year his accounts are evasion, he has to just follow this. That his returns will be estimated 1 rupee additions everywhere. Every receipt, every payment, and then 1 rupee extra. Like good old days, our parents, when they used to eat, they used to sit down for dinner, they will remove a puri for kutte ki, one for kawa and all. The same way this tax evader will do this, 1 rupee additional for every receipt, for every asset. Will he not get out of this in Sec 6? It's a possibility. We are looking at a bug today. It's a distinct possibility that somebody can do this because I have done this. I have put it and estimate 1 rupee. Now you go and estimate whatever, because no case of evasion, let me assure you, I got the highest experience, best experience. No case of tax evasion in assessment is on foolproof addition. It is ultimately an estimate of what it is. I can assure you that. No case of tax evasion in assessment is pure and simple, this is the income. It is always an estimate of what could be receipt and what could be income, what could be expenses. One of the biggest bugs that I can see in this provision is here, that by giving to